Hi, and welcome to the Real Talk Podcast with Gary Kelly. That's me. And I'm joined today by the ever debonair Brad Avergon from Fairway, Always Independent Mortgage.
Hi, Gary. How are you?
I'm great, Brad. How are you?
I'm doing great, thanks.
So, we're talking about a number of credit topics since you're a loan officer. Um, on one occasion, I remember, I'm going to tell you a story. I was out working with a client that was a wonderful client. Not all clients are wonderful. This was a wonderful client. Her husband was in the military. He was off fighting a war somewhere, and she was at home trying to find a place for them to live. Okay. And I remember she looked at a number of places, and because of the price point of what she could afford, she was looking at stuff that was, let me use the term rough. Okay. It was, in some cases, pre-foreclosure, beat up. It would require a lot to fix it up. And I remember her father in particular coming out saying, why are you showing her this stuff? It's really not what we would want to move into. I remember looking at him saying, because it's all they can afford. They need help. And within a week, she came back and said, my dad gave us some money. And it made all the difference. Okay. It really did. When that happens, how does the mortgage company look at that? Is that a good thing? Is that a bad thing? You just can't have found money showing up in a bag. So you've got to keep track of it. How do you guys go about doing that?
So the first thing we do is we kind of look at the situation, and that's part of my interview process when I'm kind of talking to a client, even before they do the pre-approval application. I'm just working with a piece of paper and a pen, and I'm going to ask them and say, all right, we'll talk about your income. What's your income? How much of it is base salary or hourly wage? How many hours a week do you work? And have you been there a couple of years, and do you get any bonus? And if so, how much? So we get into that a little bit, but then we talk about assets, and I'll say, all right, let's split off any retirement money that you have. Let's just talk about checking and savings. What do you have there? And they'll give me a ballpark idea. Some people are more specific. They want to log into their account on their phone or whatever. But other people, I just need a ballpark number. And that will tell me something. And then I'll say, okay, do you have any brokerage accounts? Do you have anything like that? Still non-retirement. And some of them do, a lot of them don't. And then we'll talk about retirement.
A brokerage account would be from a company like Fidelity or Schwab or one of those.
Right. Exactly.
It's not
So
the real estate brokerage.
Oh, yes, absolutely. I'm sorry. I should have clarified. Yeah. So, some sort of a financial management company. So, like you said, a Fidelity, a Schwab, a Merrill Lynch, anything like that. And so I'll look at that, and then I'll look at retirement funds too, because a lot of folks don't realize that there are times that you can use retirement funds to your advantage without making a taxable event. So that's something that I'm able to help with folks with. And then we look at that and we say, okay, given this is how much funds you have, and given that I don't want to leave you eating macaroni and cheese out of a box at the end of this whole process, we need to make sure we leave some money back in your accounts when all is said and done, for reserves, in case the car breaks, the water heater goes, whatever. You need to have some money left over. So let's segment in our minds this much money to work with this transaction. And if that's enough to be able to get a good property, that's great. If it isn't, I may suggest to them, say, is there family members that you think might be willing to help contribute to this in the form of a gift? And oftentimes they'll say, well, they've kind of intimated that they might, but nobody's been specific. And I'll say, that's terrific. First of all, kudos to your family for being willing to step in. But I'll say to them, why I suggest to you that you follow up with them and ask them, just for working purposes, what sort of number would they feel comfortable committing to, so that we can integrate that into your plan. And by doing so, they don't have to give them the money now. It's just that they've committed down the road saying, this is what we feel comfortable doing. Now we have something tangible we can work with, and I can help create a model of a home that might be a little bit more livable, more comfortable to live in, than one that, or perhaps it is a home that needs a little bit of work, like the one you're talking about. But rather than put a bigger down payment down, maybe we can use a lesser down payment and segment some money aside for some of the renovations if it's a good opportunity for them.
I recently worked with someone that bought a foreclosure, and it was rough. It just was. And they've gone in and have spent hours fixing it up. But it was a situation where he was in a position, along with his out of work brother, to kind of go through the house quickly and do a marvelous job. The young woman I was referencing earlier didn't have that kind of capability, didn't have that kind of support, and so was kind of left with, I'm going to have to hire people if I can find them, kind of thing. And it puts them in a different, I'm going to say, more awkward position when you look at something that is, a little bit more challenging to work with.
You're absolutely right, Gary. And what's really funny is a lot of times folks will be looking at that, and one of the things they're surprised about is when I say to them, let's assume we're putting 5 or 10% down. I said, well, if we let's just boost it up just a little bit. Let's just boost it up. Um, let's say we boost it up $50,000, just for example. Well, if we're putting only 5% down, that's an extra $2,500 of down payment money. Okay, not a lot. And sometimes just that extra increase in the mortgage amount is not as much as they think it would be, but it makes a huge difference when looking at a home for, let's say, 500,000 versus $450,000. There's a big gap there in those homes as far as how much work you would have to do into the home when you moved in. So they're surprised sometimes that they can get a house that's a little bit more turnkey than would be otherwise, and they don't have to go out searching for those folks to try to get that, and then the timing, and then of course living through that while they're living in the property. Not an easy thing to do.
Now, what about a renovation loan? There are people that offer money to fix the place up. How does that count into the calculations?
So when you say there are people that offer money to fix the
Let's
place
say
up,
a 203K renovation loan.
okay.
That's not found money. That's, in my mind, Gary's explanation. That's money that you're going to ultimately have to pay for in your mortgage. And you need to make sure that the house you buy will support a valuation that includes that. But it doesn't go into down payment and that kind of thing, correct?
No, it does. It does not go into down payment. So a 203K for your viewers and for your listeners is a program under the Federal Housing Administration that allows you to come in and put down 3.5% of not only the purchase price but the renovations, the additional renovations that you're going to do on the property. And depending on the extent of those renovations, if it's roughly the quick and dirty rule is I use $30,000. If it's up to $30,000, you could do something called a streamline renovation, 203K, where you can buy the property. You can get, you have to have your contractors lined up with written estimates. I mean, there's a little bit more due diligence that has to come from you and from the contractor in order to get this loan to close. But you get that information, you get the bid lined up, and let's say it's a bathroom and a kitchen facelift, so to speak. We can do that. Contractor can get their money, 50% of their money up front, and then the 50% when it's done. If it's more extensive than roughly $30,000, there is you do have to get a U.S. An FHA inspector in there that kind of tells you what you're going to need and make sure that you're going to meet those criteria to get the work done. And that can be a very extensive renovation. That can be hundreds of thousands of dollars, but you're going to have somebody kind of standing by your side, and you are going to pay for that person. There's a charge for that, but it does allow you to, again, finance those costs to renovate the property into the purchase price.
Brad, if someone wants to reach out and talk to you, how would they do that?
Best way to reach me, Gary, is via my cell phone, which is 978-375-5531, or via my email, which is brad@bradabergon.com.
Great. Brad, I want to thank you for coming on the Real Talk podcast and participating today.
Thanks, Gary.